Picture this. At this very moment, as you are listening to these words, a massive fracture has just appeared on the surface of the global financial system. The figure of $110 per ounce of silver is no longer a forecast of dreamers. It is manifesting on every trading screen with an uncontrollable velocity. This is not a normal price rally. This is a stampede away from paper promises to uncover the true value of a physical asset that has been suppressed for decades. Right now, portfolios are being silently shredded, while most of the world remains oblivious. Turn off the television, close every other tab, focus entirely on the analysis I'm about to share, because what you are witnessing is not a projection, it is reality in motion. By staying here, you are already ahead of 99% of investors who are staring blankly as their wealth evaporates. Subscribe to the channel and hit the notification bell to never miss the underground financial insights that mainstream media will not touch. And before we go further, I want you to think carefully. Where are you observing this seismic shift from? London, New York, Singapore, or somewhere else? Drop your location in the comments. This is not just curiosity. Mapping the true observers is part of understanding the scale of what's happening as the old financial world begins to crack. The fracture we are seeing, the irrational gap between physical silver prices and paper contracts, is the final warning sign of a system that has run out of liquidity. Vaults at major exchanges are flashing red, signaling stress at the core of the market. Meanwhile, global demand from AI, data centers, renewable energy, and high-tech infrastructure is driving a thirst for silver unprecedented in history. If you think this is just another temporary spike, think again. This velocity is not random. To understand why silver is surging, you must look beneath the surface of the price tickers, into the hidden plumbing of the COMEX and the London Bullion Market Association. We are now experiencing extreme backwardation. In a normal market, silver for future delivery costs more than silver today due to storage and insurance. Today, that logic is reversed. Buyers are paying a massive premium for immediate delivery, a direct signal that physical demand is crushing the paper market. This is a subtle signal most investors will miss, but for those watching closely, it is screaming the truth. The paper market is becoming irrelevant. For decades, the silver market has been artificially suppressed by leverage ratios that defy logic. For every 1 ounce of physical silver in registered vaults, over 400 ounces of paper silver are traded digitally. It is a house of cards built on the assumption that not everyone will demand their metal at the same time. That assumption has just failed, and when it fails, the consequences are immediate and brutal. We are witnessing a historic short squeeze, a systemic event that dwarfs all previous silver rallies. Bullion banks, long the suppressors of silver prices, have reached a breaking point. Internal positioning shows giants like JP Morgan and HSBC shifting from massive shorts to aggressive longs. They are no longer hedging, they are hoarding every available bar of physical silver, signaling that the market dynamics have fundamentally changed. Imagine the very hunters who once suppressed prices are now the hoarders. They have flipped the game entirely. Liquidity is evaporating. Intraday swings of 5 to 7% in minutes are reshaping hundreds of billions of dollars in market value. Meanwhile, the spot price on screens is diverging from reality. While digital quotes hover at $110, the cost of acquiring 1,000 ounce bars in the physical market is 30% higher. This is not a small discrepancy. This is the true price of silver, and the difference between paper and physical has never been more pronounced. The leverage ratio of 400 to 1 is collapsing. Margin calls trigger forced buying, creating cascading pressure that reshapes the market. The dollar index sliding toward 97 leaves no ceiling in sight. This is not a bubble, it is the repricing of a finite, essential resource in a world of infinite currency expansion. If you think the past was chaotic, remember 1980. The Hunt brothers attempted to corner the silver market, sending prices from $5 to nearly $50 an ounce. They were ultimately crushed by regulatory intervention. The rules changed overnight, margin requirements skyrocketed, and exit doors were closed. Today, the players are not individuals, they are sovereign states, and the scale is global. This is a ghost of the 1980 squeeze, magnified into a systemic event. The 2008 financial crisis and the silver spike of 2011 were mere tremors compared to what is unfolding now. Back then, paper liquidity saved the system. Today, paper itself is the problem. A fundamental shift in power is underway from west to east, while the United States and Europe focused on debt expansion and digital assets. BRICS nations, led by China and India, executed multi-year strategies to secure physical resources. The Shanghai Gold Exchange trading consistently above London and New York was a silent signal of this strategy. The East was willing to pay premiums for real metal, while the West relied on paper promises. Every digital ledger in the West is losing relevance, while physical vaults in the East grow heavier with real assets. Trade tensions, tariffs, and geopolitical brinkmanship are not just political theater. They are battles for control of strategic metals required for technological and industrial dominance in the next century. Each tariff, threat, or trade war drives another nail into the coffin of the petrodollar system. Do not underestimate the scale of this shift. It is not incremental, it is structural. Silver is the nervous system of modern industry. AI data centers, renewable energy projects, electric vehicles, and solar panels all consume silver at extraordinary rates. Solar installations alone are projected to require over 125 million ounces this year, accounting for nearly 20% of total annual supply by next year. Efficiency gains cannot offset this sheer volume. Meanwhile, the military-industrial complex adds another layer. Guidance systems, hypersonic projectiles, and fighter jets all rely on silver. Once used, it is destroyed, removing it permanently from circulation. This is strategic demand in its purest form, rising as global defense budgets hit record levels, creating a market where price sensitivity is nearly irrelevant. Mining output is flat at roughly 813 million ounces per year. We are now in the fifth consecutive year of structural deficit, with a cumulative shortfall of more than 820 million ounces since 2021. Inventory buffers are drained, and retail shortages are becoming widespread. Exchanges can no longer supply industrial demand, forcing direct sourcing from mines and refineries. The first is what I call the confidence shock. If the independence of the Federal Reserve is openly questioned, or if investigations into its leadership escalate, the dollar index could break below 97 almost instantly. In this environment, gold and silver could enter a parabolic phase, with price jumps of 10 to 20% happening in hours. The second scenario involves tariff escalation. If a 100% tariff on Canadian resources is implemented, it would effectively double the cost of essential inputs overnight, sending a wave of inflation through global supply chains, and silver would be the first asset to fully price in that shock. The third possibility is a margin flush. Exchanges could raise margin requirements to levels that force retail investors out of their positions, triggering massive forced buying from those short against the metal, which would amplify upward pressure and create a self-reinforcing surge in prices. To navigate this, managing leverage is absolutely critical. Anyone trading silver with borrowed money becomes an immediate target in these volatile conditions. At the same time, you need to pay close attention to the subtle signals beneath the surface of the price. Lease rates, physical premiums, and flows in the registered vaults all tell a story the digital ticker cannot. Finally, you must be clear about your objective. Are you here for a quick trade, or are you positioning to protect generational wealth from a dying currency? History shows that the biggest gains go not to the fastest traders or the smartest analysts, but to those who prepared before the crowd understood what was happening. Right now, you are watching this because you are ahead of the curve. You've observed structural deficits, industrial choke points, and geopolitical shifts that most ignore. The weight of the metal in your hand is worth more than any digital ledger. The next 72 hours could define the next decade of your financial life. Stay sharp, stay patient, and above all, stay safe, because the reality unfolding today will be remembered as one of the most pivotal moments in modern financial history.